Over the last 8 years, I've focused on building passive income streams for me and my family. So in this video, I'm going to share with you my top 5 investments for earning passive income. I currently hold 4 of these investments, so I'll talk to you about the benefits and drawbacks, how much money you need to get started, and the percentage yield that I've managed to make on each one. If you're new to my channel, I'm Kiran, I'm a chartered accountant, and I make personal finance videos on how to grow and manage your money. Let's start off the list with buy-to-let property. There are 2 types of property that you can invest in: residential property and commercial property. You would then rent it out to somebody in exchange for rental income each month. Investing in residential property is one of the most common assets that people invest in because it's concrete, literally, which means that it gives people a sense of security because they can see and touch the physical asset that they've poured their money into. Real estate belongs to an asset class known as real assets because it's physical, and it's a way of allowing people to diversify away from stocks, and it also provides more security than the stock market. I bought my first buy-to-let when I was 26. My investment has been great for 3 reasons. First of all, the property is high in demand. Secondly, I can increase the rent every year. And thirdly, as well as providing me with a monthly income, the asset is also rising in value. So I'm seeing a capital appreciation on my asset as well. A major drawback of buy-to-let property though is that you have to save up a significant deposit. So in the UK, if you were to take out a buy-to-let mortgage, you would typically need a 25% deposit, which for most people is a lot of money. On top of that, you would need to pay property tax, which in the UK is stamp duty land tax, surveyor's fees, legal fees, valuation fees, and then on top of that, you need to pay income tax on your rental income. So let's say you were earning 1.5k a month in rental income and you were a basic rate taxpayer in the UK, so you had a 20% tax rate. That would mean you were paying 20% tax on $1,500 every single month. The calculation is a bit more complex than that because you can deduct certain costs from your income, but you get the general idea of how the tax works. So once you've actually received your rental income, paid your mortgage, paid your income tax, you won't be left with that much money at the end of the month. But having a physical asset can be sensible as part of a diversified portfolio. And if you have a property manager, then the income is completely passive. On my properties, my gross yield is around 6%, which could be higher in the stock market, but I want to diversify and I know that my properties will also rise in value, so I will see a capital gain on them as well. Number 2, REITs. The UK and the US have a special type of company called a REIT, which stands for Real Estate Investment Trust. And this is an alternative way of investing in property. You don't need to save up a deposit for the property and you don't have the headache of managing the property yourself. Investing in a REIT is like owning a slice of a very large pie. The REIT is a big real estate company and it will own commercial properties or residential apartments, and that will make up the full pie. And then you, as the individual investor, will buy a share in the REIT and that will be your slice. So effectively, you will own a share of those properties as well. There are different types of REITs that you can invest in. So you could invest in a residential REIT, which owns apartment buildings, or a retail REIT, which owns shopping malls, or an office REIT, which owns office spaces. One of the biggest benefits of REITs is that they have to pay out 90% of their taxable profits to shareholders. So you are pretty much guaranteed passive income because you will receive a dividend each year from the REIT. And a lot of the time, REITs actually pay out a bigger dividend than classic dividend paying companies. Another big benefit is that you get to own property without the headache of having to manage the property yourself. But one of the major risks is choosing the right REIT. For example, after the pandemic, office REITs like SL Green and Boston Properties suffered major losses. I hold an investment in Annaly, which returns around 10 to 12% a year. Number 3, car parking spaces. Parking can be a real headache for drivers, and so there are people in certain areas who are willing to pay for a parking space. I don't hear many people talking about this one, but it's a really straightforward way of earning passive income. Renting Renting out a car parking space in an area that A, doesn't have enough affordable parking, and B, is very busy can be a very easy way of earning passive income. Developers typically charge an extra 5% of a property's value for a car parking space. And so if you have a space that you're not using all the time, then consider renting it out because it could have some value. I own a car parking space which I bought alongside an apartment, but my current tenant doesn't have a car. And I was talking to somebody one day who needed a parking space 2 days a week. So I offered them a rate that was cheaper than the nearest multi-story car park, and they took me up on the offer. So now I'm earning truly passive income from that car parking space. If I hadn't have done that, the asset wouldn't be working for me at all, and I wouldn't be making any money, and it's most likely that neighbours would be taking advantage of the empty parking space. Using the 5% valuation metric, I'm making around 5% yield on the parking space. Number 4, dividend paying stocks. When you buy shares in a company, those shares can either pay you a dividend or not pay you a dividend because the company has a policy of reinvesting all of its profits back into the business. For example, BT usually do pay a dividend twice a year, whereas Amazon reinvest all of their profits back into the business in order to expand the company. So these types of shares would be held for capital appreciation. And a dividend is just a distribution of the company's profits back to shareholders. For an investor, that's an important form of passive income because it really can help to boost your income. But investing in individual stocks does come with a caveat because you need to research each company. In particular, you should look at the company's dividend policy and also look at whether the company has historically paid dividends. And then you would want to look at some key ratios like debt to equity, earnings per share, and return on equity. If you're not comfortable doing that or you just don't know what to look for, then alternatively you can invest in a dividend paying fund, which is essentially a basket of stocks, and you can find funds that do pay dividends to shareholders. This might be an easier way of investing in dividend paying stocks, especially if you're a beginner. But if you do want to learn more about individual dividend paying stocks, then I would suggest looking at blue chip dividend stocks. These are industry-leading companies that have historically paid a dividend, companies like Apple and MasterCard. You could also go away and have a look at dividend aristocrats, and these are companies in the S&P 500 which have consistently paid a dividend for the last 25 years, and that dividend has increased year on year. Companies considered to be dividend aristocrats include Realty Income Corp, which is a REIT like we spoke about earlier, IBM and Amcor PLC. One dividend paying stock I hold is Microsoft, and that has a typical yield of just under 1%. Number 5, alternative investments. Alternative investments are ones that are not easily converted into cash. So we're talking collectibles like cars and fine wines and commodities like gold. And when you think of these investments, you don't typically link them with passive income because usually you might buy something like a piece of art, hold it, hope that the artist becomes famous, and then one day sell it and make a capital gain. But there is a way that you can invest in art and make passive income. But I'm not talking about investing in a piece of art, which could never bring you passive income, but rather investing in art-backed debt. That means that you would invest in an art loan. So a third party who holds a private art collection would take out a loan and secure that loan on their art collection. They would then pay interest on the loan every month, and the investor would receive a monthly return on their investment. This has become a growing sector, especially as art and finance have started to converge more and more. And typically this type of investment was only available to institutional level investors, but it's becoming more and more mainstream. So it's definitely worth looking into if you want to diversify and if you're looking for an alternative form of passive income. If you found this video helpful, then please hit the subscribe button because it really will help my channel to grow. Thanks for watching, and I'll see you next week.